Welcome to the Deep Dive. We're here to unpack critical insights for you.
And today, we're taking a really fascinating look at a company that might just be the quiet engine room of the entire AI revolution.
Exactly.
Mm-hmm.
We're diving deep into Nebius Group, a name you might not know yet, but honestly, one that could be absolutely essential for understanding where AI is headed.
Yeah. Our mission today is basically to give you a shortcut, to being well-informed about what looks like a remarkable opportunity. It's currently flying way under the radar for most people.
Right. And in a world that's changing so fast where, let's face it, the traditional paths to building wealth feel less reliable, maybe even broken.
Uh-huh. Fiat currencies feeling shaky, a steady job.
Hmm.
It just doesn't feel like enough for true financial freedom anymore for a lot of folks.
So we're constantly searching for those high growth opportunities, right? Those moments where things shift, where disruptive forces create new ways forward.
And today's deep dive is exactly about uncovering one of those forces, Nebius, and how it might accelerate not just AI itself, but also your understanding of these critical economic shifts happening right now.
We're going to explore how Nebius is positioning itself, not just for survival, which is amazing in itself given their story, but for explosive growth,
Yeah.
right at the foundation of the AI economy.
Okay, so let's unpack this. The AI revolution. Everyone's talking about it.
Oh yeah, it's everywhere. ChatGPT, smarter chatbots, you name it.
But it all hinges on something fundamental, something often overlooked. It needs immense, just unprecedented computational power.
It's not just clever code, it's raw horsepower behind it all.
Exactly. Think of it like, I don't know, a new industrial revolution. You need the factories, the power plants, not just the inventors.
And that's where Nebius steps in.
Right. Imagine a company valued around $9 billion currently.
It's still under the radar for many.
Completely, yet it's rapidly becoming this indispensable backbone for the global AI industry.
They're building the full stack infrastructure. They are, quite literally, AI's engine room.
And the scale required is just mind-boggling. When we talk about fueling AI, it's not just a few servers.
No, it's like computer cities. That's a good way to put it. Huge data centers needing colossal amounts of electricity.
And megawatts, MW, that's the term you hear. Think of it as the literal gas for AI.
Fueling models like ChatGPT, which are incredibly power hungry.
Insatiable demand. And Nebius gets this. They're rapidly expanding capacity to meet it. They're not just selling hardware, they're building the whole environment these GPUs need.
So if they are this engine room, providing the tools, the power, what does that actually mean for the AI companies using them? Startups, even big guys?
Well, it means they can potentially move faster, be more agile. Nebius isn't just about raw compute. They deliver the infrastructure, sure, but also tools, specialized services.
Which lets nimble startups and even giants like Meta.
Yeah, Meta, who use them for Llama, a major competitor to OpenAI.
Right. It lets them build, train, deploy these cutting-edge models more efficiently.
Exactly. They provide the building blocks, the compute, the management layer, so these companies don't have to build it all themselves.
Okay, but this leads to the really wild part of the story. How did a company with roots deep in Russia, a spinoff from Yandex, basically Russia's Google,
A $31 billion giant at its peak.
how did they navigate that geopolitical turmoil, frozen trading for years, and then just emerge as this fast-growing AI champion?
With what was it, 122% stock jump since trading restarted in October 2024?
Yeah, it's not just tech. It's this incredible story of resilience, reinvention, a really unconventional path.
It really is. And you have to understand the origins to get Nebius today. It's a phoenix story, truly.
Born from the ashes of Yandex. Back in 2021, Yandex was huge, dominated search, maps, ride-hailing, e-commerce, AI in Russia and nearby markets.
A digital powerhouse. $31 billion peak valuation. A titan.
And then 2022 happened, the Ukraine situation.
Everything changed. Suddenly, immense geopolitical pressure, moral dilemmas, financial chaos, trading suspended internationally, sanctions.
Operations tangled in regulatory issues. Just an impossible situation.
Totally untenable. And in this incredibly bold move, around 2,000 engineers, leaders, researchers, founders, they chose to divest.
They made a moral stand, essentially. Walked away from the Russian operations.
That's what it looks like, yeah. Walked away rather than compromise or get further entangled. A massive decision.
That kind of stand, though, did it create challenges? Or maybe unexpected opportunities? Because that decision kicked off this incredibly complex corporate restructuring.
Oh, absolutely. Took 2 years, navigating sanctions, shareholder pressure, politics, divesting all the Russia-based assets.
Until mid-2024, when the formal separation was complete.
And Nebius was born. completely independent, free from the past.
And this next point is critical, right?
Absolutely crucial. There is no connection now. Legally, operationally, none. Between Nebius and Russia.
Leadership got Dutch or Israeli citizenship.
To ensure full compliance, signal that clean break. HQ is now in Amsterdam.
But they kept something vital, didn't they?
Yes. Critically, they retained a key Finnish data center from the original Yandex assets.
Which gave them that deep engineering DNA, existing infrastructure.
Yeah.
A head start.
Exactly. They carried over the technological brain, so to speak, not starting from absolute zero.
Which explains why they flew under the radar. No flashy IPO, no roadshow.
None of that. It bypassed the whole traditional process. The CEO, Arkady Volozh, even said he was caught off guard. Learned just 3 days before NASDAQ switched the Yandex listing to Nebius.
Almost accidental, or at least super unconventional.
Which created this lack of initial market visibility.
And that, right there, is what makes it so interesting today, an asymmetric opportunity.
Yeah, for you, the listener, that means the potential upside for those who dig in early could be way bigger than the perceived risk, just because the wider market hasn't fully caught on yet.
Most people haven't even registered what happened.
And just to simplify, when we talk about what Nebius does, think data centers exclude AI brain storage.
Where the complex computations happen, the learning, the thinking.
Without these brains, AI is just theory. Nebius builds and expands these brains fast.
Which brings us to the numbers, and they don't just pop.
They explode. Yeah, the growth phase is phenomenal. Q1 2025 revenue, $55.3 million.
Which, okay, might not sound huge for a $9 billion company in isolation.
But the growth rate, that's the key. 385% increase year over year. That trajectory is stunning.
It's the acceleration that matters.
Exactly. And it gets even better. The core AI infrastructure business that hit an annualized run rate revenue, ARR, of $249 million as of Q1.
Just to clarify, ARR for everyone that's projecting yearly revenue based on current performance.
Right. And that $249 million ARR, up an incredible 684% year over year.
Wow.
And it's accelerating. April ARR was already around $310 million. That shows incredible momentum, month-over-month growth from Q1.
Demonstrates the model works and they can scale like crazy.
Right, scaling to meet that massive demand.
And those megawatts we mentioned.
Yeah.
The gas for AI. The electricity for the computer cities.
They're expanding there rapidly, too, around 90 milliW contracted capacity now.
Enough to power tons of these AI servers.
And they're aiming for 100 milliW by end of 2025. But the longer-term vision...
It's kind of nuts, right? Over 1 gigawatt by 2026.
Yeah, 40x increase in capacity in under 2 years. That's not just growth, it's a massive leap to meet future demand.
And to fuel all this, they needed cash. Big cash.
And they got it. $700 million in strategic equity financing. Notably, including a big chunk from NVIDIA.
NVIDIA itself, that's huge validation.
Absolutely, a powerful vote of confidence. And more recently, another $1 billion through convertible notes.
Which is debt that can turn to equity later. Flexible funding.
Exactly. It shows serious backing for their role in AI infrastructure.
And the market is definitely noticing now. Stocks boomed 122% since trading restarted.
And over 150% from its April lows. That's the kind of action investors look for. Signals growing recognition.
Okay, but what about profitability? Are they actually making money yet?
Good question. Right now, they're deep in CapEx capital expenditure, pouring money into building out infrastructure.
So, negative cash flow near term. Makes sense for hypergrowth.
Right, but the underlying business model, once scaled, is inherently high margin. Management expects adjusted EBITDA, that's a key measure of operational profit, to turn positive in the second half of 2025.
Okay, so profitability is on the horizon.
They think the core business might even break even by Q3. And the medium-term goal, billions in revenue, with adjusted EBIT margins of 20–30%.
So ambitious but achievable targets, not just speculative tech.
It's a scaling infrastructure play with a clear path.
Which brings us to the big question. Can this incredible growth keep going? What's their secret sauce? What's driving it?
Okay, so this is about Nebius's moat. Why they're different. It's not just another GPU supplier.
Right. You mentioned they were built for AI from the ground up, unlike AWS, Azure, Google Cloud.
Exactly. Those guys often retrofitted existing platforms. Nebius optimized every layer hardware developer experience specifically for AI needs.
That's a key difference. Like an AI boutique versus a general store.
A great analogy. And this built for AI idea comes down to their engineering-led vertical integration. That's a core differentiator.
Meaning they control the whole value chain.
Pretty much. They
Okay.
design their own racks, servers, even motherboards collaborating closely with NVIDIA, custom built for GPUs.
Which means they bypass markups from companies like Dell or Supermicro.
Right. Passing savings to customers, like a chef growing their own specialty ingredients for quality and cost control.
And they design their own data centers, too, engineered for efficiency.
Yeah, often own them too, like the Finland facility.
Yeah.
But they also use colocation strategically, Paris, Iceland, Kansas City for reach,
So end-to-end control, hardware to cloud software.
which allows tight integration, faster innovation, better cost control, almost unheard of outside the hyperscalers.
And this is possible because of their engineering team, those X folks.
Absolutely. Nearly 400 experienced AM and cloud engineers, many with over a decade of experience. That's a huge asset.
And this control translates into real benefits, right? Cost and energy efficiency.
Definitely. Tangible benefits. Prices often 20–25% lower than average GPU providers. That's significant.
And the energy side, that Finland data center sounds amazing.
It is 19th most powerful supercomputer globally. Uses free cooling ambient air, no chillers, no water, no refrigerants.
Super efficient, super cost effective.
And they even reuse the server heat. Over 80,000 milliwatters between 2020–2023 for municipal heating in a nearby town.
Covering 50% of the town's heating, cutting household costs by 12%. That's incredible.
Their power usage effectiveness, PUE, is around 1.13. That's elite territory, right up there with Google and Microsoft.
Wow. And then there's the NVIDIA relationship. You mentioned it's a trifecta.
Yeah, few companies can claim this. Client, strategic partner, and shareholder.
That's huge. Early access to NVIDIA's latest hardware, Blackwell GB300.
Yep. First in Europe, one of the first globally. Lets them build next-gen systems way ahead of competitors. Huge advantage for their customers.
And NVIDIA actually owns shares in Nebius, about 1.2 million.
Underscores it's more than just vendor-customer, it's a deep partnership. And in June 2025, Nebius was named a reference platform NVIDIA cloud partner.
Joining an elite group. So it's a deep collaboration, not just buying chips.
Precisely.
And they seem really focused on the customer experience, the developers.
Totally. Customer-obsessed cloud, that's a massive differentiator. They work closely, offer customization, flexibility, things the big guys often don't.
Which attracts startups and big players like Meta using them for Llama development.
Right. And unlike hyperscalers demanding rigid multi-year GPU commitments.
Nebius offers spend-based discounts, on-demand GPUs, simpler contracts.
Exactly. Transparent, predictable pricing. Contracts are like 3–5 pages, not 200. Their AI Studio platform simplifies access to open source models too, Llama, Mistral, etc., with really low cost per token inference.
And the support piece seems key. Customers rave about fast, responsive support.
Consistently.
Yeah.
That's often a huge pain point with the larger providers. Nebius seems to nail this.
Let's talk about some real-world examples. Customer stories really bring this to life.
Good idea. Higgsfield AI, an AI video startup. They chose Nebius specifically for the extremely startup-friendly approach.
Praise the transparency, fair pricing, flexible consumption.
Right, preferring spend-based discounts over rigid quotas. And crucially, they found the infrastructure reliability on par with Google Cloud and AWS.
Despite Nebius being newer globally, they like the AI Studio and responsiveness too. Strong endorsement.
Very. And Dylan Patel from SemiAnalysis, a respected analyst.
What did he say?
He noted Nebius supports the full spectrum of models, bare metal, direct hardware access,
Right, for maximum control.
to orchestration tools like Slurm and Kubernetes for managing complex workloads.
And standard APIs for integration, so super adaptable.
Exactly. Patel highlighted their engineering talent designing racks, partnering with NVIDIA as key to better economics and performance at lower cost. That's high praise.
Then there's Lynx Analytics, a global AI firm.
They needed fast, scalable GPU clusters for heavy computations. They explicitly said better reliability after data losses elsewhere.
And they like the GDPR-compliant European clusters for sensitive data.
Yep. And their architect found the UI simpler, more intuitive, more enjoyable to use than AWS, which apparently involved editing complex JSON files for basic tasks. That's a developer pain point Nebius avoids.
Okay, and Sentinel, the infrastructure optimization company.
Using bare metal, they noted consistent performance where newer providers sometimes wobble. They loved the early access to NVIDIA hardware H100, H200, B200 before wide availability.
Keeping them cutting edge.
And they valued the flexible contracts, on-demand pricing without sacrificing cost. Called it the best performance per dollar solution. That's a powerful statement.
And there are tons of others, right? Chat fuel, robotics, drug discovery.
A real breadth. Chat fuel improving chat bots, London Institute for Mathematical Sciences doing LLM research, positronic robotics training robots, crisp cutting training time 50-80%, Dubformer for AI dubbing, Recraft for generative AI.
The common theme seems to be that mix of performance, flexibility, support, and cost.
Exactly. It's a compelling package for a wide range of AI companies.
So after hearing all that, the critical question remains, can they maintain this edge? Can they really differentiate against giants like AWS and Azure long-term, or will they get squeezed?
That leads us right into the big picture, the market opportunity, and importantly, how Nebius is addressing the risks.
Because the market itself is insane, right? A gold rush.
Absolutely explosive growth, projected $33 billion in 2023 to over $260 billion by 2030 for AI infrastructure.
That's a compound annual growth rate, CAGR, of 35%. That's huge sustained growth.
Massive. Driven by AI adoption everywhere and the need for compute-intensive stuff. And inference using trained models is set to become the dominant cost, 64% of server spending by 2027.
Up from 34% in 2023. A big shift from training to deployment.
And the specific GPU as a service in AI cloud markets, expected to grow 8-fold in 7 years. Huge runway for specialists like Nebius.
So where does Nebius fit? You called it a neo-cloud.
Right. A new generation, purpose-built for GPU-hungry AI. Rivals like CoreWeave, Lambda Labs, Together.ai are in this space too. It's distinct from the hyperscalers AWS, Azure, GCP.
Who offer broader, more general services.
Exactly. And hyperscalers often prioritize their own internal AI needs first. Search engines, assistants, etc.
Meaning they can't always optimize for the niche, high-performance stuff AI companies need.
Often, yes. Even Amazon's CEO admitted AWS's AI cloud could grow faster if not for capacity constraints. They can't always meet external demand.
Which leaves this big opportunity for neo-clouds like Nebius. Especially for the GPUs not snapped up by the giants.
Precisely. Maybe 30–40% of the GPU supply? Nebius aims for the full spectrum. AI startups, the coming wave of large enterprises adopting AI, even national AI projects like Israel's supercomputer.
Okay, but let's tackle the bear cases, the worries investors have. What about that DeepSeek panic?
Yes. When news about DeepSeek's low development cost tanked Nebius stock 40%.
Yeah, that seemed like an overreaction.
Totally. Market realized quickly the claims were overblown. Major tech earnings reaffirmed multi-year AI spending plans. No slowdown.
Plus, isn't there that paradox, Javon's paradox?
Exactly. Increased efficiency doesn't cut consumption, it increases it. Cheaper compute means more AI adoption, not less.
And NVIDIA's CEO projecting $1 trillion data center spend by 2028, needing 100x more GPU power for new models. That counters this slowdown idea.
Definitely. And the idea that hyperscaler CapEx is slowing is also nuanced. Hardware demand isn't the same as compute demand. AI infra isn't cyclical like old IT upgrades.
Nebius grows based on actual demand.
Right.
More flexible.
Right. And hyperscalers often can't meet external demand anyway because they need the capacity internally.
What about chip obsolescence? GPUs getting outdated fast?
Well, they don't become useless overnight. H100s were still sold out in March. And Nebius's vertical integration designing next-gen racks with NVIDIA helps future-proof them, reduces costly upgrades. Their engineers are key here.
Okay, and the not profitable yet point.
That's standard for hypergrowth, heavy investment phases, prioritizing market share, build-out. The payback on GPUs like Hoppers is 2.53 years, totally normal.
And they offered some software free initially to attract users.
Right, but those will become high-margin revenue streams. They expect positive adjusted EBITDA H2 2025, aiming for 20–30% EBIT margins medium term, like AWS, eventually over 30%.
So the path is clear. What about AI infra just becoming a commodity?
Not yet. There's still a massive supply-demand imbalance. New models need way more compute. Enterprise adoption is just starting. Winners deliver specialized, reliable, high-performance infra at scale. That's Nebius's game plan.
And finally, the Russian past perception.
Yeah, despite misconceptions. Gotta reiterate, legally, operationally, completely severed.
Yeah.
HQ Netherlands, leadership Dutch-Israeli. That gap is closing with every report, every customer win.
So the real debate is execution. Can they beat the giants, navigate supply chains, or will those perceived risks bite them?
But they are undeniably positioned as Europe's key AI player now.
Okay, let's look ahead. Future playbook, key takeaways. Why could this be a multi-bagger?
Their 2025 outlook is super clear and ambitious. Scale up big time with Blackwell chips.
Aiming for $750 million to $1 billion ARR by year-end, $700 million revenue, and turning adjusted EBITDA positive in H2.
Yes, and aggressively expanding globally. Iceland live, Kansas City live with B200 soon.
And that massive custom New Jersey facility. Under construction, scalable to 300 million W, all Blackwell.
Huge. First capacity late summer 2025, plus exploring sites worldwide like Israel. It's global ambition.
The strategic goal isn't just building data centers, though, right? It's about leading Europe's AI infrastructure.
Exactly. Challenging U.S.-China control. Deploying Blackwell across Europe, aiming to 10x the continent's compute capacity. That positions them as a geopolitical beneficiary, too, a potential cornerstone of European AI independence.
Oh, absolutely. Significant hidden value, potential funding levers most people miss. Of RIDE, the autonomous mobility unit.
Capital efficient, only $310 invested, needs maybe $150 more to profit. Spun from Yandex's self-driving unit. Yep. Already doing robotaxi rides, $47K plus. Delivery bot orders, $200K plus, with partners like Uber, Grubhub. 0 serious accidents in 22M plus autonomous kilometer.
Partnering with Hyundai for 100 robotaxis in the U.S. by end of 2025. And Nebius owns 100%.
Correct. Conservatively, could be worth $5 billion plus SUB. An upcoming funding round for Ivreed will be a key benchmark and could unlock capital for Nebius Core.
Then Toloka, the AI data platform.
Crowdsourcing high-quality training data. Revenue doubled, 140% YoY growth FY24. Clients like Anthropic, Amazon, Microsoft.
You got that 72M investment led by Jeff Bezos' fund and Shopify's CTO.
Right. Nebius gave up majority voting but keeps a big economic stake. Estimated value $300 conservatively. Compare that to Scale AI at 29 Baylors. Another funding round expected there too.
And Triple 10, the EdTech platform.
AI-powered e-learning, high job placement, 87% in 6 months. Enrollment doubled YoY Q4 2024. Operates US, LATAM, Israel.
Affordable learning, estimated 40-60M revenue 2025, maybe $75 evaluation, plus a talent pipeline.
Strategic benefit often overlooked.
And the big one, that 28% stake in ClickHouse.
Hugely significant hidden asset. High-performance database used by Meta, Microsoft, Spotify.
Expected to triple its valuation to $6 billion in a new funding round.
Which makes Nebius's 28% stake worth roughly $1.68 billion pre-dilution. That's over 20% of Nebius's current market cap.
Wow, a major financial lever. And ClickHouse might IPO in 12-24 months.
Could further crystallize that value. Big potential boost for Nebius.
Okay, so beyond execution, what external catalysts could drive the stock higher? Get it re-rated?
Several things. Institutional coverage is very limited now. If JP Morgan, Goldman Sachs start covering them as they hit targets, big institutional money could flow in.
Makes sense. And major contract announcements, especially from that New Jersey data center.
Exactly. Big multi-year deals with OpenAI, Google, Microsoft. That provides revenue visibility, huge validation.
What about geographic expansion?
Southeast Asia expansion, starting with Singapore, makes them truly global. Potential for anchor clients, data centers across Asia.
And Europe's AI sovereignty push.
Nebius is perfectly positioned. Most energy-efficient, cost-effective AI cloud in Europe. Ideal partner for national compute projects.
Plus, just continued transparent reporting, hitting targets, dispelling those old misconceptions.
And showing that operating leverage. Moving from negative to positive cash flow. That's a huge turning point for investors.
And they've already raised guidance once for 2025. More upward revisions would signal even stronger conviction.
Definitely accelerate re-rating.
And the leadership sounds solid too. Arkady Volozh, the founder-CEO, built Yandex into a giant.
Proven visionary. And heavily invested, personally owns 15%, 90% of his net worth, hold majority voting power, strong alignment with shareholders, long-term vision.
His public condemnation of the war, supporting employees, underscores ethical leadership.
It's a founder-led company backed by seasoned operators who rebuilt it independently with a global focus. Can't overstate that.
So wrapping this up, Nebius Group really seems like this underappreciated, undercovered company.
Building absolutely critical infrastructure for the AI revolution.
With that unique mix of tech, partnerships, financial discipline, hidden assets, it looks like a classic asymmetric opportunity.
Yeah, a compelling risk reward that the market's just starting to figure out. It's not just investing in a company, it's potentially investing in the foundation of the future AI economy.
The question for you, our listener, really is, as this world transforms, are you prepared to spot this kind of disruptive innovation before everyone else catches on?
This knowledge isn't just facts, it's about foresight, having that edge.
Thank you so much for joining us on this deep dive into Nebius Group today.
And remember, understanding these kinds of high-growth opportunities, these disruptive forces, it's a powerful way to grasp where things are heading, find new paths to growth. The old ways just won't cut it.
So what's your next step to explore this evolving world? What would you question? What new areas will you explore? And how will you choose to invest in your own growth and understanding?
Keep questioning, keep exploring, and keep growing.
We'll see you next time for another deep dive.